Today is the 1st of July 2026. And if you have superannuation, several rules that affect your retirement income changed today. Some of these changes work in your favour. Others introduce new obligations you need to be aware of. And one of them, the new tax on very large super balances, has generated more questions than almost any other super change in recent years. In this video, I am going through every significant change that takes effect from today. What it means in plain English. And what, if anything, you need to do about it. Let us go through them one by one. As always, this is general information only. It is not personal financial advice. The changes I am covering today are based on information from the Australian Taxation Office and Services Australia. For advice specific to your personal situation, please speak with a licensed financial advisor. Here is what we are covering. The transfer balance cap increased to $2.1 million. The new Payday Super rule for anyone still working. The increase to contribution caps. The Division 296 tax on balances above $3 million. And what has not changed, because there's some confusion out there about that too. The first and most significant change for retirees is the transfer balance capital. The transfer balance cap is the maximum amount of superannuation you are allowed to transfer from your accumulation account into the retirement phase, where your investment earnings are tax-free. From the 1st of July 2026, this cap increases from $2 million to $2.1 million. That is an increase of $100,000. Now, who does this actually affect? The answer depends on where you are in your retirement journey. If you are starting a pension for the first time on or after the 1st of July 2026, your personal transfer balance cap is $2.1 million. You can transfer up to that amount into the tax-free retirement phase. If you already have a pension that started before the 1st of July 2026 and you have never hit or exceeded your personal cap, you are entitled to a proportional increase. How much of the $100,000 increase you receive depends on how much unused cap space you have. The ATO will calculate this automatically. You can check your personal transfer balance cap by logging into myGov, selecting Australian Taxation Office, and looking under your super information. The updated personal caps will be visible from the 13th of July 2026, not from the 1st of July, so do not be alarmed if you do not see the updated figure immediately. If you have previously exceeded your transfer balance cap at any time, you are not entitled to any increase. Your cap stays locked at the level it was when you exceeded it. If you transfer more than your transfer balance cap into retirement phase, the ATO will issue what is called an excess transfer balance determination. You will need to return the excess amount to your accumulation account and pay excess transfer balance tax on the earnings that amount generated. The practical takeaway here is straightforward. If you have a large super balance and you were previously limited by the $2 million cap, you may now have the ability to transfer an additional amount into the tax-free retirement phase. Whether and how to do this is a decision worth discussing with a financial advisor. The second change is called Payday Super, and it affects anyone who is still working while receiving the age pension or drawing from super. From the 1st of July 2026, employers are required to pay superannuation contributions on the same day as wages, or within 7 business days of each payday. Previously, employers were only required to pay super quarterly. For most retirees who have already left the workforce, this change has no direct impact. But if you are still working part-time while drawing on super or receiving the age pension, this change means your super contributions will arrive in your account more frequently. This is generally a positive change because it means your contributions are invested sooner, and you are not waiting up to 3 months for contributions to appear. If you are still employed and have a super account, check your next payslip after today to confirm super is being paid in line with your wages. If your employer is not meeting the new Payday Super requirement, you can raise this with them directly or report it to the ATO. For self-employed people who make their own contributions, the Payday Super rule does not apply to you directly. The third change affects anyone who is still adding money to their superannuation account. From the 1st of July 2026, both the concessional and non-concessional contribution caps have increased. The concessional contributions cap, which covers before-tax contributions like employer super and salary sacrifice, increases from $30,000 to $32,500 per year. The non-concessional contributions cap, which covers after-tax contributions, increases from $120,000 to $130,000 per year. These increases also flow through to the carry-forward concessional contributions rules. If you have a total super balance below $500,000 on the 30th of June 2026, you may be able to carry forward unused concessional cap amounts from previous years and contribute more than the standard cap in a single year. The potential catch-up contribution in 2026 to 27 could be as high as $175,000 for some people, depending on their unused cap history from previous years. If you are already fully retired and not making contributions, these cap increases may not affect you directly. But if you have a younger partner still working, or if you are considering making a one-off contribution before fully stopping work, these new higher caps give you slightly more flexibility. The fourth change is the one that has generated the most discussion. It is called Division 296 tax, and it applies to people with a total superannuation balance above $3 million. From the 1st of July 2026, if your total super balance exceeds $3 million, the investment earnings on the portion above $3 million will be taxed at an additional 15%. This is on top of the standard 15% tax that already applies within the accumulation phase. This tax only applies to the portion of your balance above $3 million. So if your total super balance is $3.5 million, the tax applies only to the $500,000 above the threshold, not to your entire balance. There is one important and controversial aspect of this tax. It applies to unrealised gains. This means even if your investments went up in value during the year, but you did not sell anything, the increase in value can still be counted as earnings for the purposes of this tax. This is unusual compared to most other tax rules in Australia, and has been the subject of significant debate. The vast majority of Australians are not affected by this tax. The $3 million threshold is very high. According to ATO data, only around 80,000 people across the entire country currently have a super balance exceeding $3 million. That is less than 0.5% of all Australians with superannuation. If your balance is below $3 million, this change has no impact on you whatsoever. If your balance is above $3 million or approaching it, this is an area where speaking with a financial advisor who specializes in retirement is genuinely worthwhile. I want to take a moment to address something I have seen causing confusion, because several people have asked me about it. The minimum pension drawdown rates have not changed from the 1st of July 2026. I know there was some expectation that they might, but the rates that applied in 2025 to 26 continue to apply in 2026 to 27. As a reminder, the standard minimum drawdown rates by age are as follows. For ages 64 and under, the rate is 4%. For ages 65 to 74, it is 5%. For ages 75 to 79, it is 6%. For ages 80 to 84, it is 7%. For ages 85 to 89, it is 9%. For ages 90 to 94, it is 11%. And for age 95 and over, it is 14%. These rates apply to your account balance, as at the 1st of July each year. If your balance has changed significantly this year, your minimum payment amount will change accordingly, but the percentage rates themselves remain the same. The deeming rates used by Centrelink also have not changed today. They were last updated in March 2026 and will next be reviewed in September 2026. Let me bring it all together. From the 1st of July 2026, there are 4 significant changes to superannuation. 1. The transfer balance cap increases from $2 million to $2.1 million. Check your personal cap in ATO online services from the 13th of July. If you have never exceeded your cap, you may be entitled to a proportional increase. 2. Payday Super takes effect. Employers must pay super on the same day as wages. If you are still working, check your next payslip. 3. Contribution caps increase. Concessional cap goes to $32,500 and non-concessional cap goes to $130,000 per year. 4. Division 296 tax applies to investment earnings on super balances above $3 million. This affects a very small number of Australians. And one clarification. The minimum pension drawdown rates have not changed. They remain the same as 2025 to 26. The best way to see how today's changes affect you specifically is to log into myGov, go to the ATO section, and look at your super summary. Your updated transfer balance cap will be visible from the 13th of July. If you have questions about contribution strategies or the Division 296 tax, a licensed financial advisor who specializes in retirement is the right person to speak with. If this video helped you understand what changed today, please subscribe. I post new videos every Wednesday and Saturday covering superannuation, Centrelink, and aged care in plain English for Australians in retirement. This Saturday, I will be going through super minimum drawdown rates in detail, including how to calculate exactly how much you need to withdraw this financial year based on your balance and age. Subscribe so you do not miss it. And if you have a question about how today's changes affect your situation, drop it in the comments. I read every one. See you Saturday. Take care.